Welcome back to Switzerland, Australia's business channel. Now, joining me now is one of the scariest business writers in the world. I've got town written there, but it's the world. Christopher Joye of the AFR and Smarter Money Investment is here to give us his latest on the so-called housing bubble, the vulnerability of our banks, and why he doesn't approve of the government guaranteeing deposits of our banks. There's got to be some good reason for some of his orneriness. My producer didn't know how to spell that. I don't know if I spell it right either. But you are extraordinary ornery. Every Saturday when I read you in the Fin Review, you just scare the pants off me.
Hey, you've got to remember that I was nominated as basically the biggest bull in Australia on housing during the global financial crisis.
Right then.
Every major bank in the country rolled me out in front of their clients.
Yeah.
The investment banks took me to Singapore, Hong Kong to convince people why house prices wouldn't fall 40%.
And I told people how smart you were. That's why the AFR gave you a job. I said how smart you were.
But facts change and my views change.
Yeah, that's right.
So, I think with the housing market right now, it is fascinating because 12 months ago I was sitting here saying, the RBA's cut the cash rate to 2.5%. I think we'll get double-digit house price inflation. Yeah. And I think people will get worried, and certainly I was concerned, about a bubble of sorts developing. And it is certainly in vogue right now. Even the governor of the RBA is jawboning heavily against housing. We've had double-digit...
Oh, yeah, yes, I agree with that.
Just let me finish. We've had double-digit house price gains. Sydney house prices are up 14...
You call it inflation a moment ago. That's an exaggerator. But go on.
We've seen Sydney house prices up 14, 15, 16%. And what's
Which one is it? 14, 15 or 16? So you're
actually 14,
you're like a journalist now.
14% as of the latest cut, but a month ago it was 16%. But here's the point. This housing boom is actually quite different to the previous episodes in 2007 and 2010. In 2007 and 10, we had first-time buyers participating strongly in the market. First-time buyer participation is very low. This is an investment and speculative-driven housing boom, and actually we're seeing higher levels of investment participation as a share of all home loans approved than we even saw back in 2002, 2003. And what is concerning is that 55% of all investor loans are interest-only, so they're not even paying down any debt. So I think there's reason to be... I think there's lots of information that should give us pause. I think the market's about 20% overvalued, looking at house price to income ratios.
The national or the Sydney
No,
one?
the national market. So the house price to income ratio since 1990 has been 3 times. Yeah. Since 2000 it's been 4 times. It's currently over 5 times. So the market's expensive. I don't think anyone disputes that.
No, I agree.
And I think the concern I have is, I think we're okay right now, but the concern is if prices continue shooting higher, and I think they will run harder until the RBA raises rates, because you've got foreign buyers, self-managed super, guys gearing cash 5 times.
Yeah, but foreign buyers, that's not a problem for us. That's a problem for them, isn't it, really? At the end of the day, if a foreign buyer makes a mistake, we get to buy his assets when he has to sell them off.
That's one way of
looking. He's not borrowing money off us.
That's one way of looking. But if they cut their losses quickly and they force it...
I listened to you and I really do agree with lots of it. And you did predict big house price rises. You were worried about... I predicted big house prices and saying yes, because, as you know, Sydney house prices rose very slowly for about 10 years. Now, if we get 2 years of what we've got, I say yes, housing bubble. I think next year it'll be more subdued. It might be 10%. If it's 10%, what would you say? Is it a housing bubble or is it just a housing boom?
Well, I think we've had 11% capital growth for the last 12 months. And if we've got another 10% worth of house price appreciation, I think the wages are growing at 2 to 3%. And I think the way to think about this is that if house prices continue to appreciate at 3 to 4 times the rate of income growth, that's a problem. The other problem is
that will stop the price growth.
Maybe, maybe not. Okay. You overlay foreign buyers and you overlay self-managed super funds that for the first time ever can gear their cash 5 times. There's $600 billion in self-managed super. They've never really used it to invest in residential property, and they can now take 80% LTV loans and purchase investment properties. So I think this market... And then the final dynamic is record low borrowing rates, the lowest borrowing rates we've seen in 40, 50, 60 years. So I think we're in uncharted territory.
Explain what you're saying, lowest borrowing rates?
Yeah, we haven't seen mortgage rates this low since...
interest rates you're talking about.
Yeah,
but one thing I found fascinating about your article the other day, and many things was fascinating, question marks, and I'm sure I brought it in to show you.
You've got to read the Australian Financial Review, that's the key point.
Well, no, I just read it so I can criticise you, but you got some good points there. And one of the interesting one was the debt to income ratio.
Yeah, so the debt to income ratio. So can I just make this point? The household debt to income ratio in Australia,
your show after all,
in 1991, in the recession, everyone says, oh, like housing fared well in 1991, which was the last recession we had 23 years ago. But in 1991, the household debt to income ratio was 50%. Today, it's 150%, and it's basically about to breach the previous peak, the all-time high of about 153% reached in 2006. And the issue is that household leverage is increasing again. Housing credit growth is running at 6 to 8% per annum, so twice income. That's irrelevant. That argument is absolutely bogus. What Peter's saying is, oh, we're not getting housing credit growth of 14% per annum.
Like we did before the GFC.
Like we saw during the 1990s and 2000s, but it's all relative to incomes. Income growth was much higher back then. My point is that housing credit growth is running at 2 to 3 times wages or income growth, and that's a concern.
You know what the part that really worries me you leave out of this, and a lot of bankers tell me this, and you might not trust the bankers, but they tell me that an enormous percentage of Australians are overpaying their mortgages. They've got an enormous buffer in, and I haven't seen the number, but
no, they're right. I mean, basically, I think the RBA's buffer. Yeah, the RBA it's actually RBA analysis that says that on average, I think people are about 12 months ahead of schedule.
Yeah. Which is a very enormous. We never did that back in the 90s, did we? I can tell you, I was there. You were probably running around Scots College, you know.
Geelong Grammar, mate. but yeah, so on the mortgage buffer point, that's all fine when you've got 4.6% mortgage rates. Yeah. But if you've got 6.6% mortgage rates, that mortgage buffer can evaporate pretty quickly.
And also, I always figure you're right on housing bubble concerns if unemployment goes to 8 or 9%. I can't see it going to that level.
Yeah, that argument I don't buy either, and simply put, for this reason.
You don't test that argument in your article. So I'm saying, why didn't you test this one out, Chris? But go on now.
I actually use that argument in the GFC, but here's the point. We have never really valued housing as a financial asset class, and I think that's changing. Yeah. So historically, house prices have always risen. The biggest fall in house prices in the last 30 years was 8% in, lo and behold, 2011-12. And what happened in 2011-12? Nothing, right? And I think that you could see big mark-to-market changes, so valuation shifts through changes in sentiment, the likes of which we've not seen before. And what I mean by that is, if the RBA lifts rates 1 to 2% higher, suddenly we're paying 5.5 to 6.5% mortgage rates. House prices are going to fall. They might only fall 5 to 10%. But then I think people are going to start to very seriously reevaluate the fundamentals of housing vis-a-vis everything else they can access. And I think we'll see a 10 to 20% correction. It's not the end of the world.
No.
And it'll actually be just giving back those gains.
People aren't losing their jobs, because you've got friends that lived in Palm Beach, you saw their prices drop by 40%. Yeah. Now, if they didn't have to sell, they're now laughing because they're starting to come back.
That's right. We own property in Palm Beach. In fact, we still own property in Palm Beach.
Yeah. So there are a number of variables that make me think that you're a worst-case scenario. You're not the most likely scenario, because you made the point there that a lot of the buyers are investors. These investors are well-heeled baby boomers with a lot of money, and so they aren't going to be as pressured when interest rates go up as a first-home buyer who could lose his job at a Coles or Woolworths supermarket.
Sure.
These people are much stronger borrowers. The greatest fear we should be talking about is that first-home buyers are losing out to wealthy baby boomers, but I don't know if it leaves the economy more vulnerable.
Yeah, so my point is I think we can see 10 to 20% house price falls in the absence of a big increase in unemployment, just like we saw a 50% fall in the value of Australian equities in 2008, and the economy was okay in 2008. It wasn't the end of the world. The second point is that I'd ask you this question. Do you think owner-occupiers, who own about 65% of all homes, are going to be more likely to hold on to their principal place of residence and elect not to sell it if house prices fall 10 to 20%, as opposed to investors who already own a home and live in a home, but they've got 2 or 3 extra investment properties? Do you think they'll cut their losses more quickly than owner-occupiers, or vice versa?
Well, I think it'll get down to this. If I can't service my debt, then I will sell it. But I think rents are going up, and in that sort of scenario, I can't see rents falling. People are still going to have to live somewhere. But it's a really interesting argument, and I recognise that if we get a lot more house price rises, I would worry. I think the Reserve Bank, if they were as worried as you, they would have already started to raise interest rates. What's your argument on that?
Yeah, no, I agree with you. I think the RBA hasn't been as concerned as I was 12 months ago.
They newspapers on Saturday, that's why.
No, they didn't necessarily buy into my thesis 12 months ago, but I think they're much closer to where I am today.
Now, APRA's been a fantastic regulator. I don't know if you agree with them, but I think they have been.
Yep.
they don't seem to be saying, I'm worried about the banks, but you seem very worried about the banks, Chris. So tell us why.
Okay, this is all in the context of the Murray Financial System Inquiry. David Murray, former CEO of CBA. I've been writing about
Friends
this...
of Switzerland program.
Yeah, I've been writing about this for 1 to 2 years, and basically my argument has been that I expect the banks to be forced to hold more capital, both to compensate for their too big to fail status, but also because the capital they hold against home loans is way too low. And I think
$1.50 for every $100 loan
of home loans. Now, I've been writing again about this point, the risk weighting issue, which some people might have heard about, that the banks only hold $1.50 of capital for every $100 of home loans they lend. That number, everyone signed off on, and it's ludicrous. And the first recommendation that David Murray made in his 460-page interim report was we need to look at increasing risk weightings. That is, we need to increase that $1.50 to something that is more reasonable. Because people in their heads, when they invest in the major banks, they think, oh, they've got 10% Tier 1 capital. But in truth, they don't, because that capital is measured against something called risk-weighted assets. And effectively what the major banks, this is no exaggeration, what the major banks do across all their home loan books, and we're talking about hundreds of billions of dollars worth of home loans, is they assume that some percentage of those home loans is completely risk-free. Yeah. So the question is, what's a reasonable percentage?
Do we know?
Prior to 2008, the banks used to assume that half of the home loan, 50% of the home loan, was completely risk-free. Today, they're assuming that 85% of the home loan...
Well, I think 85 makes more sense than...
Is completely risk-free. Yeah. Risk-free.
Yeah, so I think 15% would be dodgy, but 85, that's a good number.
But it's risk-free.
Yeah, but why...
Sorry, do you mean at risk or risk-free?
What about APRA? APRA must know what they're doing.
APRA agrees with me. APRA, I've spoken to APRA about this for a couple of years.
APRA can tell banks to change it.
Yeah, no, I said to APRA, do you not think
off
that
the record they agree with you? Yeah, you've just put them on the record, but go on.
You're a smart ass, seriously. No, bottom line is, David Murray, the Financial System Inquiry, most banking experts believe that the banks need to hold more capital, and what that means is more equity, more capital to protect them against future losses, and less leverage. Here's the interesting statistic. In 2004, the major banks were about 20 times leveraged. Yeah. If we look at their true equity capital measured in dollar terms, relative to the true dollar value of home loans and business loans and all loans on their balance sheets. In 2014, they're about 22 times leveraged. Yeah. So leverage has actually increased and capital has decreased. It's a very complex and technical issue. The only reason Tier 1 capital looks like it's increased post the GFC is mainly because the major banks went from assuming that half of their home loans were risk-free to 85% of their home loans were risk-free, and Shazam, suddenly we're carrying more capital against those risk-weighted assets than we previously assumed.
Yeah, very complex.
It is complicated.
But no more complex than you using the word MEM. I had to go to Google to look up MEM.
It's an idea,
No one uses MEM in the real world. You're using it.
Can I just quickly on APRA?
I'm going to give you half an hour next time.
Yeah, sure. But quickly on APRA, I think the point is that UBS and Morgan Stanley both assess that the major banks' shareholder returns will fall by 10% following the recommendations in their base case from the Murray inquiry. Yeah. So I think there's a bit of downside.
But the government has to actually put them in.
Yeah, it does.
The banks could pressure the government not to do that.
They could do that. And the banks could also use their oligopoly position to reduce costs and pass on cost to borrowers, so to preserve margins. I'm just simply saying there's downside to valuations.
Okay. I've got to bring you back, and we've got to talk about why you don't like the government guaranteeing the 20. That's a really important one. But next time you come back, I'll give you 20 minutes, or I'll usually give you 11, which is long for this show. Sure. But you never shut up, and you are interesting marginally. So thanks for joining us, Chris.
Thanks, mate.
Okay, so that was Christopher Joye. As he likes to tell you, he writes for the AFR. Coming up, my next guest plans to take on the formidable organisation ResMed. This won't put you to sleep, I promise.